Americans just piled up more debt than at any point in history. The Federal Reserve Bank of New York put the number in writing, and it is a warning about your credit that almost nobody is reading correctly. This is not just a scary headline. Buried in that report are the exact pressures that decide your interest rates and how easily you get approved this year. What if the real story is not how much the country owes, but the quiet shift underneath it that is about to make your own credit harder to manage? Meet Renee. She works full-time, pays her bills, and still feels like she is falling behind, with her balances creeping up a little more every month. Then she hears the country just set a debt record, and it hits home. Following Renee, we cover 4 things: what the new record actually is, and what the Federal Reserve report measures, where the real stress is hiding, and it is not your mortgage, what a debt record like this means for your credit and your rates, and the moves that protect you before it reaches your own accounts. Here is the catch. A giant national number can feel like someone else's problem. Keep watching, because the part about credit cards and rising late payments is the piece that lands directly on people like Renee, and it is coming up fast. Part 1. What this new record actually is. Every few months, the Federal Reserve Bank of New York publishes a report on household debt and credit. It adds up what American households owe across everything: mortgages, car loans, student loans, and credit cards. In its most recent reading, total household debt reached nearly $18.8 trillion, the highest level ever recorded. $18.8 trillion. That is not a typo. That is the new normal. Now, a number that big is almost impossible to picture, so do not try. What matters is not the size, it is the direction and the mix. The total keeps climbing, and the pieces that are growing fastest are the expensive ones. That is the part that touches you. The report also tracks something more telling than the total. It tracks how many people are falling behind on payments, and by how much. When those late payment numbers rise at the same time the debt total rises, it tells you households are not just borrowing more, they are starting to struggle with what they already carry. For Renee, this is the moment it stops being abstract. That national chart climbing on the screen is made of millions of people who feel exactly like she does, watching their balances drift up while their paycheck stays the same. This is the part the headlines skip, and it is the part that matters to you. Most of that $18.8 trillion is mortgage debt, and mortgages are generally the calm part. They are locked in, often at low fixed rates, and most people keep paying them. So the giant total by itself is not the alarm. The alarm is credit cards. Credit card balances have climbed to around $1.25 trillion, another record, and unlike a fixed mortgage, this is the most expensive money most families carry. And here is the warning sign. The share of people falling behind on their credit cards has been rising. More households are sliding into late payments on exactly the kind of debt that punishes you the fastest. Rising balances on the highest interest debt, plus rising late payments. That is the combination that hurts. Why does this matter for your credit specifically? Because credit card behavior drives your score more than almost anything else. How much of your limit you use and whether you pay on time are 2 of the biggest factors there are. When the whole country leans harder on cards, more people quietly cross the lines that drag a score down. That is Renee's real risk, not the $18.8 trillion. It is that she is one of the millions letting a card balance creep up. And that creep is the thing that actually shows up on her report. Quick pause. If a clear breakdown of what these debt numbers mean for regular people is the kind of thing you wish more channels did, hit like and drop a comment below. I read every comment and reply personally. Share this with someone who has been feeling the squeeze, and do not forget to subscribe because we put out several new videos every week. Drop a comment and tell me, do your balances feel higher this year than last year? Yes or no? I want to see how many of you are feeling the same pressure Renee is. Part 3. What a debt record like this means for your credit and your rates. When lenders get nervous, they do not lower the bar. They raise it. Here is the chain reaction. When more people fall behind, lenders see more risk. When they see more risk, they get pickier about who they approve, and they charge more to the people they see as borderline. That means tighter approvals and higher rates, especially for anyone whose credit is not clearly strong. So the same score that got you an easy yes 2 years ago might get you a maybe or a worse rate in a tighter market. The bar quietly moves. And the people who feel it first are the ones sitting right on the edge, the ones with a decent but not spotless file. There is a second effect that is sneakier. As your own card balances rise, the share of your limit you are using rises with them. That single ratio can pull your score down even if you never miss a payment. So a rising debt environment can lower your score through your own balances without a single late payment, just from using more of your available credit. For Renee, that is the trap. She could keep paying on time, feel responsible, and still watch her score slip, simply because her balances are higher than they used to be. Part 4, the moves that protect you before this reaches your own accounts, and the honest caveats. You cannot control the national number. You can control the 3 lines on your own report that lenders actually look at. Move 1, attack the highest interest balance first. Not the biggest one, the most expensive one, usually a credit card. Every dollar you knock off there does double duty. It saves you interest and it lowers the share of your limit you are using, which can lift your score. Move 2, keep your card usage low relative to your limits. Paying your balance down before the statement closes, not just before the due date, is what gets a lower number reported to the bureaus. That one timing habit can move your score without you earning a single extra dollar. Move 3, build a small buffer, even a few $100s, so the next surprise does not become the missed payment that actually damages your report. A tiny cushion is what keeps a bad month from becoming a bad year on your credit. Now, the honest caveat: these numbers are a snapshot and they get revised as new data comes in. This is not a prediction that a crash is coming, and it is not a reason to panic. It is a signal to tighten up your own file while the choice is still yours. Do the boring things now, and a nervous lending market becomes someone else's problem, not yours. All right, let's lock this in. Part 1. Total household debt hit a record near $18.8 trillion, and the direction and mix matter more than the size. Part 2. The real stress is not mortgages, it is credit cards, now around $1.25 trillion, with more people falling behind. Part 3. A record like this pushes lenders to tighten and charge more, and your own rising balances can lower your score even with no late payments. Part 4. Attack the most expensive balance first. Keep your usage low and report a low balance, and build a small buffer. The country's debt is a headline. Your 3 lines, balance, usage, and on-time payments, are the story you actually control. None of this is about fear. It is about using a warning while it is still just a warning, so the tightening happening out there never reaches the one file that belongs to you. If this helped you, give it a like and drop a comment below. I read every single comment and reply personally to your questions. Send this to someone who has been stressed about money lately, and make sure you subscribe, because we put out several new videos every week. And the next video you should watch could save your score in the worst month of your life. It breaks down exactly what happens to your credit at 30, 60, and 90 days late, the hidden grace window most people never use, and how to stop one missed payment from wrecking your report. Make sure to subscribe so you don't miss it. It'll be uploaded within the next 2 days. See you there.